Hello, with me today I have Matthew Jennings, Equity Income Investment Director at Fidelity. He's here to talk about the Fidelity Global Dividend Fund. Hi, Matthew.
Hello, good morning.
Now, global stock markets have just had the worst months and worst quarter many of us will have ever seen. Very few portfolios have escaped unscathed. Now, one of the big investment themes of the coronavirus pandemic has been the massive impact on dividend paying stocks. Now, how has the Fidelity Global Dividend Fund performed during the crash? And are you satisfied with performance?
We have quite a conservative investment approach on the Fidelity Global Dividend Fund, meaning that we tend to prefer businesses which are quite stable, which have not too much debt on their balance sheets. This has meant that we have actually been able to hold up relatively well in comparison to a market which, as you say, has fallen very, very dramatically. Just to put some numbers on that, if that's of interest to you, the fund in sterling terms is down about 10% over 3 months, and that's in comparison to a market which is down little bit over 16%. So that's a fairly considerable margin of outperformance, which, as I said, reflects the conservative and cautious approach that we take on the fund. In terms of, are you satisfied with how it's done? I mean, I think considering the unprecedented events that have unfolded over the last few weeks, we are reasonably satisfied. It's never nice to say you're satisfied with a 10% drawdown. This is a meaningful drop in performance, but it's one that we feel we will be able to recover from.
Okay. I mean, equity markets remain volatile. Again, it might be an unfair question, and perhaps impossible to answer, but just interesting to get your view. I mean, do you think the worst is over? I mean, that's what a lot of investors will be asking. Have we seen the bottom yet? And how will we know for sure?
Well, the thing about equity markets is you'll never know for sure, and there's always surprises around the corner, whether it's relating to the coronavirus or something else. It will never feel 100% safe to buy into equity markets. And by the way, the time when it does feel 100% safe is probably not the best time to be investing, because prices will be high and expectations will be high. So that uncertainty is really part of the challenge of equity in investing. I think what you're seeing from markets at the moment would suggest that expectations are that the lockdown programs that many countries have put in place are effectively constraining the spread of the virus. I think markets have taken some hope from the fact that the number of cases in Spain and Italy seems to be leveling off, as well, of course, from the fact that China and other Asian countries have managed to contain the spread of the virus. So from a kind of behavioral point of view, it would seem that we are past peak pessimism, peak worry, peak uncertainty, and people are now beginning to think about what lies on the other side of this lockdown. So potentially, but there's always room to be surprised.
Yeah, well, exactly, and the UK banks. I mean, referring back to sort of the dividends. I mean, they've just had their dividends cut. They've been convinced to cut them across the board. We're going to see more dividend suspensions on a daily basis. Today, it's the insurance sector that's getting hit hard as dividends are cut there. Now, what's your view on these forced dividends suspensions? I mean, like we've seen at the UK banks. I mean, a lot of investors here will only own the high street bank shares. I mean, do you think this might be extended to other sectors? We've heard oil possibly, but what are your thoughts on that?
Okay, well, this is a very complex question. There are many reasons why a company might choose to cut its dividend. In the case of the banks and the insurance companies, this is really the regulatory bodies, and it's certainly not just the UK, but other countries in Europe have taken this position too, that instead of paying dividends, banks should be holding on to the cash, and in order to give themselves a buffer through the economic slowdown that we're undoubtedly experiencing just now. So in the case of the banks, it's really a response to sort of the regulator. For other companies, thinking about retail here, maybe Marks and Spencer, for example, has cut its dividend in the UK. Inditex, the Spanish retail group that owns the Zara brand, has paused its dividend or deferred its dividend for the time being. These haven't been enforced by a regulator. They're decisions that the companies themselves have taken in order to, to survive, the current, withdrawal of revenues from their sector. So there are many different reasons for companies cutting dividends. And I would say that it's important to look at this on a case-by-case basis and look at each individual company's sensitivity to, first of all, the things that are happening in the economy, but also the regulatory and political context. So we're seeing companies in France, for example, if there is a state, if the state owns part of the company, the French government has said, we don't want you to pay a dividend. So that's something, that has to be taken into account now. Just because you asked about oil specifically, again, this is really a different question in the sense that oil companies obviously have suffered as a result of big falls in the oil prices. We should remember that what's happened in oil markets is really that demand has fallen as economic activity is reduced, but also supply has increased because of the disagreement between Saudi Arabia and Russia. So this has been the worst possible combination of factors for the oil industry. So far, it seems that Shell, BP, and other oil majors will try to continue paying their dividend. They haven't announced cuts so far. Shell hasn't cut its dividend since the Second World War, so it will be very reluctant to do so. That's not to say that it won't at some point be forced into a dividend cut if oil prices don't recover. Now, sorry for the long-winded answer there, but I'm just trying to make the point that there are lots of different reasons for companies to cut dividends, and it's really hard to generalize too much about this.
Yeah, of course. Well, look, I mean, given the growing dividend scarcity, where do investors find income in the equity space, certainly in the near term? And we don't really know how long this is going to go on for, but should they be adjusting their investments, tinkering with the portfolio, or will they just have to adapt to lower yielding portfolios?
Well, that's again a question where I think it's going to be difficult to make too many generalizations. Every individual investor, of course, will have different income requirements. So if someone, is relying on a certain level of income from their portfolio every year, then it might be that some adjustments are required, and a focus on those companies that are more likely to pay dividends is justified. However, I would say that this is a time when thinking long term can really add value, because many of the companies which cut their dividends this year may not, in fact, may be able to begin paying a dividend again quite soon after the lockdown ends. So I'm thinking about, well, you've mentioned the UK banks. Depending on the nature of the recession that we have, it is quite possible the banks will be in a position to begin paying dividends next year, and maybe even that dividend will include some part of this year's dividend too. So I think if investors can look 1, 2, 3 years ahead, I would encourage them to do so. This is when you have lots of uncertainty around, it can be difficult to think long term, but it can also help to deliver better investment results if we're able to do that.
Matthew, you've kind of answered part of my next question already, which is about sort of when do you see a return to dividend normality? I mean, are we talking 6 months, a year, more than a year? Is it too soon to be talking or thinking ahead that far, because companies are still coming out and cutting the payout? So, I mean, what are your thoughts on that?
Yeah, again, I think we have to be very careful about generalizing too much. I think for strong businesses, maybe in less affected parts of the market, we will be able to see a return to dividend normality, as you put it, within a fairly short period of time. 6 months, I think, is probably reasonable, 6 months to a year. For other companies, though, maybe which went into this crisis in a financially weaker position, and where where there's maybe more sensitivity to what's going on at the moment. I'm thinking about airlines, retailers, that type of business. It might take longer for dividends to recover, because the damage that's being done now is actually long-term damage.
Matthew, thank you very much.
You're welcome.